Okay, welcome everybody to CIM MES discussion group, perspectives and insights. In this session with CIM MES, we talk about, in essence, not only trends, but also the fact that the disruptors, deep thinkers, and value-added webinars that we're trying to put together. Today, we will talk about mining and the need of capital. Mauro Chiesa is advisor of the EDC, New York City Banks, World Bank. I will come back with the biography. But thank you for the sponsors. I am Gold. I'd like to come back with the CIM MES details, who we are and what we do. CIM has been around since 1898 by the Act of Parliament, 1920, CIM, Metallurgy and Mining. 1990 onwards became Mining, Metallurgy and Petroleum. We are non-profit, full of professionals. We're the biggest representative of the professionals of our resource sector in Canada, with 11 technical societies and 30 local branches across Canada and also overseas. Our vision is the trusted authority and collective source for advancing mineral industry, the knowledge, guidelines, and the best practices. And our mission is cultivate knowledge, best practices, and innovation to support our members, improve awareness of the minerals industry and society, and evolve the industry responsibly. Next slide. CIM, Mining and Economic Society of CIM, Management Economic Society of CIM. We actively work towards furthering education in mineral economics. It uses the funds it raises to support various educational initiatives and programs in mineral economics and Canadian universities. In addition to our members involved in the Economics and Management Society of Mining, CIMS has expanded to encompass members involved in all aspects of the management of companies active in the mining and petroleum sectors. We have various events throughout the year across Canada, internationally, including Hong Kong, that provides industry professionals with the opportunity to share experiences, insights, ideas on topics relating to the economics, management, and financial aspects of the business. Now, thanks to our general sponsor, I am Gold today. I'd like to introduce Mauro Chiesa. He is actively retired. He says he calls himself semi-retired, actively retired finance professional who's worked for 4 years in Ottawa with EDC, 12 years in New York City with 2 banks, and over 10 years in Washington, D.C. with the World Bank, group of the World Bank professionals. Throughout his career, Mario has focused on extractive and public and private infrastructure industries, their financing needs, and some unique extractive projects in Canada, including USA, South America, Asia, and Africa. He has 2 degrees from UBC, 1 MBA in economics, and MBA in finance. Mauro will talk about, again, the need for capital in the mining industry, and they're very related to each other. Here's the forum for Mauro. Please take it.
Okay. Actually, before we start, if you don't mind me saying a word, is if during this Mauro's discussion you have questions, feel free to post those questions on the chat box, and Mauro will answer those questions during the Q&A. Thank you.
Thanks, Carlos.
Thank you very much. Ladies and gentlemen, today I'd like to focus on mining and the need for capital and the fact that there are 3 changes afoot. Now, I showed this presentation to some venture capital firms in the course of the weekend, and they all came back 3 very enthusiastic responses and support. And with the additional proviso, this presentation should be seen by every mining graduate so they can better avoid the pitfalls that may occur on the first employment. It's absolutely essential that the new graduate get their feet wet on something that's real rather than something that's waiting. So let's put it another way. It's called change, change, and change. The first is to do with the mining, and here's the next slide. It's a simple outline before starting. The first is the mining industry, which is going through radical changes as we speak. Secondly is the capital markets, because they've gone from growth loving to dividend loving. and that's lethal for the mining industry. But there are some venture capital firms looking, but they're looking very selectively. And lastly, I'm going to focus on the mining company and how it can adapt, especially for a junior, because a review is needed of all the old processes. Fundamental changes are needed, or the capital will not come. Why? Because the capital is very, very happy elsewhere. Next slide, please. Next slide, please. Now, changing terms before starting. We've got to get some basic terms here. When I'm talking about the mining industry, I'm basically going to be focusing on copper, nickel, cobalt, lithium, gold, and silver. Now, first and foremost, mines are harder to find, and hence the mergers. There would not be mergers, and there have been mergers for the last 10 years. Why? Because simply there are no new mines that are being found. Secondly, the EVs are here, and they will need less metal, but more batteries. And thirdly, we've got another shift in the market. It's called Asia. Asia has now got 52% of global GDP, okay? 30 years ago, the G7 was 52%. Now G7 is 42%, and Asia is the glowing star. Now, secondly, I'm going to talk about the capital markets. Fundamentally speaking, the pensions must fund longer, and therefore they need far more dividends and far less risk. Thirdly, when I talk about growth stocks, I'm talking about the pensions that need stocks with safety and growth, not life of mine. And here's an example, and only an example, the FAAMA-five. That's Meta, Apple, Amazon, Microsoft, and Alphabet. Market capitalization, $8 trillion. That's 4 Canadian GDPs, if anybody wants to do the math. The 50 top mining companies now are at less than $1 trillion. Why? Because they're no longer growth stocks. Then we've got the annuities. What's an annuity? It's the opposite of growth stocks. Annuities give you fixed term investment that offers dividends. Well, that's the mining companies now. And if you want additional examples, just look at any one of 90% of mining companies that pay dividends. And you've even got some base metal suppliers like BHP, Rio Tinto, and Vale with yields now up to 10%. And what's the option? Nothing. You die. The next term I'm going to focus on is net present value versus strategic future value. Too much of the mining industry focuses on net present value, which is that $1 today is worth far more than $1 in 10 years' time. Strategic future value, and I'm going to get into one of these graphs shortly, tells you that in the future, that dollar would be far more valuable because it'll be far more strategic. And lastly, I'm going to focus on soft costs. And it's a cost generally not associated with the asset per se, which is a hard cost. It's the upfront marketing cost versus the geologist cost. It's a cost that has to be minimized by most investors and lenders as well. Next slide, please. Now, step one is the ever-changing industry. Thank you, Mr. Putin, on the OECD demand. The EU is in Brexit and changing. Japan is still in quantitative easing, pardon me. The real interest rates remain at or below zero, and I'll tell you why in a second, which is basically means that it's only good for about 6 metals. The emerging market demand is also a bit of an odd duck. It's still the largest assessment, but Russia, Brazil, and South Africa are gone. RCEP is now covering 30% of the world's population out of Asia. And with the door open to India for another 15%, it could technically represent 45% of the world's population in no time. And thanks to Mr. Putin and Mr. Xi, deglobalization is now in. What does that mean? It means that you no longer just look anywhere around the globe for the cheapest source. You now have to look at the closest source to the market to be perfectly comfortable. Last but not least, as I mentioned before, Asia is estimated 52% of global GDP, and that comes from McKinsey, and this was only 19% in 1991. So in the course of about 30 years, Asia has just blossomed into a new critical market. Now, on the demand side, you've got EVs, and the EVs could require up to 80% less metal. And the countries now support EVs from 2035 onwards. So basically, you've got a French car right now that is being tested on French roads that weighs less than 1,000 kilos. All right? It doesn't involve any metal, by the way. The French are also see the EV as a permanent fixture that only need new batteries about every 10 years. So that will really put a bend in any demand for frame metal. The Japanese are looking at something different. They're looking into a slot-like exchangeable batteries to reduce the recharging needs. And that too will put a different curveball into the demand situation. But then there's the other demand, the demand of recycling, which right now is at a mere 30% for, let's say, copper. And this could increase, of course, with metal prices. Finally, there's the supply side. The mine supply side sees that existing mines are life of mine being depleted with growing costs and more brownfields, and who knows when that's going to play out. And the new mine supply, which is harder to find, which is going to be the next slide, and the industry is no longer, the industry is no longer, has an ample supply of mines to draw from. And Goldfields has actually noted this recently in pursuing Yamana. They basically said, yes, we're pursuing Yamana because there are no new mines. So bottom line is, it's good for some metals, but uncertainty and fines prevail. In the meantime, we're going to be finding ourselves with more mergers. Next slide, please. Now, this is my career. Okay, I started in about 1975, and for about, a good many years, I had an ample supply of mines to show clients, and it was just a matter of finding a good fit, and the prospective buyer would jump in. However, for about the last 10 years, there has been a drought, and the drought is why we've gone from growth stocks to annuities for the SMEs like Equinox and New Gold. You've got the drought, that means the majors are now going into riskier upstream plays, and ALX and Noront are but examples. And the dearth also means that host countries are becoming more adamant. And we've got 4 countries where the adamancy is being shown. And so the last solution is rework the existing mines, launch new technologies, more mergers, and I only offer Yamana, Turquoise Hill, and the recently proposed Agnico Eagle joint venture with Teck as an example. But basically, this chart tells you that it's going to be increasingly difficult for a lot of people. Next slide, please. So now we have to move to capital markets. And I'm only going to show you a couple of slides here. I just want to get some of the basics involved. Look, retirees lived 6-7 years after 65 in 1971. Why? Because half the world smoked. Now it's 21 years or more because only 15% of the world smokes. Backslide, please. Actuarial tables are now on a lag and pensioners are outliving savings. France and Ontario have decided to consolidate their pension programs, and there will be more as people have to economize. And recently, GE folded on its pensions. They've gone Chapter 11, and there will be more corporates to come. Secondly, funds have bond interest income at zero. Thank you, pandemic. Not just the pandemic. Basically, look, 1970s public debt was 35% of GDP. Now in the United States, it's $31 trillion. It's 150% of GDP. So basically, interest rates are not going to be overly aggressive for about the next 20 years. Why? Because there's just massive amounts of debt out there. So basically, by keeping interest income at zero for the funds, they're going to be looking more for dividends. But the problem is that while interest is pre-tax and short-lived for the mining company, it's after-tax and eternal for the mining company. This is radically, radically different in terms of, historical perspective. As I said before, BHP, Vale, and Rio Tinto are now paying 10% or more. Barrick has just doubled. Lundin, who used to hate dividends, has actually had to start. And surprise, surprise, Goldfields is now offering to increase dividends in order to acquire Yamana. And Equinox still refuses, which is why their price to cash flow ratio has tumbled from 52 to 5 times. So basically, I'm just trying to give you a snapshot as to what's changing within the finance industry. But the finance industry also has a memory. And the funds all recall $120 billion in mining write-offs 10 years ago. And they absolutely tell you that they want less risk. So if a fund is going to be interested in junior, they'll also want to floor that junior. And you have to start wondering whether or not a junior really wants to be floored. And of course, they love the mama for US trade $1 trillion, for Canadian GDPs, as I said before, and no life of mine risk. So who wants a greenfield mine project with ample risk and a life of mine? Well, there's $123 billion in venture capital looking. Why? Because of mineral scarcity and EVs. Next slide, please. Now, here's just a simple slide I got from UBC's Keble School. But the fact is that project reality is needed for strategic future value. The bottom slide, the bottom line, the red line, is existing mine production. And that's already pretty aggressive. Why? Because as you've seen, in the last 5 years, there's been no growth. And now all of a sudden, we're going to be finding increased mine production. The remainder is the recycling to give you the economic growth. And then Scott Dunbar basically acted 70% solar and wind realization by 2050 and how much copper that would require. Well, now you know why venture capital funds are looking, but they're looking for strategic future value. Next slide, please. Now, these are just some footnotes of the prior slide. Next slide, please. Step 3. Now, I'm going to take you through some proven steps taken by, and each one of these steps has been taken by at least 3 companies that I have worked with in my retirement. All right? With no names mentioned, of course. First and foremost, it's a company that has a promising copper, silver, gold, and moly play. So it gets an office downtown. It lines up key known elements on management and board. It lines up the old accounting, legal, and engineering firms. It budgets for all the mining shows on Earth, gets a PEA done, gets a remote sensing and algorithm done, puts ESG and inclusion all over BNN, and then wonders why the stock price lingers. Next slide, please. What went wrong? First and foremost, venture capital does not like flashy downtown offices. VC wants investment to go into the mining asset, not into downtown real estate. This can inflate soft mining costs at hand. Offices are needed once a year by accountants and twice a year by engineers, maybe 3 times a year by lawyers. So consider an office that's near an airport or an industrial park instead, especially for juniors in asset sale. You know, small hint, many venture capital firms have financed kids out of operating parental garages. Next slide, please. Second point, the buddies are on board while retaining control in Tier B shares. Oh boy, there's absolutely no value to legacy appointments. We've seen this recently with Hart, who had issues with Mr. Roman from the start. There's also even less value to family-oriented appointments, and Canada's had numerous blunders here, whether it's Magna, Rogers, Eaton, or Woodward's, but there's no linkage whatsoever between genes and management. There actually also has to be need for balance to the corporate, technical, and financial expertise. One example is Pure Gold, which failed partially because there was just too many geologists on board. There were not enough operating people. And then there needs to be a correlation as well to the task at hand. You know, several mining companies I go into, I simply say, well, you know, you're going to need X technique here. You have the people that are familiar with this technique. No. Well, what are you looking for then? Well, we need somebody to believe in our mining company. Yes, but you have to have someone who at least is fluent in what's going to be required technically or geologically with this mine. No, because it's all been done with good old boys from yesteryear. And finally, the Canadian two-tiered ownership model has been a screaming failure. Look, I'm not going to go into long details here, but whether it's Falconbridge, whether it's Noranda, whether it's Inco, or whether it's Alcan, or Barrick, or Goldcorp, or Placer Dome, the two-tier model has been a failure. Why? Let's say Tier A of the shares enjoys economic benefits, and Tier B gets the governance benefits. Well, Tier A automatically gets discounted because it has no governance. And if and when Tier B falls into incompetent hands, it too becomes discounted. And this is why you've had a total sellout of Canadian mining. And even Couche-Tard understood this and has dropped the two-tier model and has subsequently prospered. So next slide, please. Next slide, please. Thank you. Thirdly, it's the traditional third-party relationships. Oh my God. I just finished dealing with one of these. There's little to no value if the accounting firm is not a big five nowadays. Why? The market is international. A recognizable logo counts. All right, first and foremost. There's also little value in the engineering firm if the firm is not well known. Same thing as the accounting firm. And you also want to avoid what I call localitis. Localitis is when the local mining company goes to the local engineering firm and gets an approval. Well, if the local engineering firm is in a smaller mid-sized town and the mining company is the only client around, of course, it's going to be favorably disposed to anything the local mining company wants to do. And the same thing goes for the legal firms. Again, redoing all the documents will simply increase soft costs all the more, and the VCs want to see not only efficient spending, but effective spending as well. Last but not least, there needs to be correlation to the task at hand. 2 weeks ago, I read a 43-101 that was 90% empty. All it had was a resource estimate, period. Total blank on everything else. Well, what's the use of putting out a sole resource estimate if you do not at least present a contemporary view of the mine project around it? And again, the venture capital simply balks at the scale of this soft cost. So basically, unheard of accounting firms. You know, I'm not going to go into names, but the company I just reviewed had an accounting firm that was not known east of Surrey. You know, I told the guy, I said, look, you want to present to the market an unknown. These people do not know this, especially with Donald Trump right now having accounting issues that his 40-year-old accounting firm has just signed off on. Basically, you just are not going to, you may think you're getting good value by traditional third-party relationships, but this is now a global market. Next slide, please. So you're going to budget to go to the traditional mining shows. Hate to surprise you here, but high tech has been around for 30 years with the infamous message of the death of distance. And you're seeing this now time and time again because many of the mining shows date from before the internet, and they're now having trouble finding subscriptions and participants. Mining shows are no longer top draws for decision makers. And many mining shows are struggling because of the internet and the pandemic. Why the analyst prefers staying at home and effectively doing more research. VCs, again, would prefer more information on the internet before the mining shows. And again, this is a soft cost inflator in need of control. Why? The VCs know that spouses like to see and spend money in Paris, London, New York City, and Singapore. And they basically say, hey, not with my money, you don't. Number 5, please. Next slide, please. So, you know, the mining company therefore gets traditional PA out to the market and goes on BNN. Oh my God, look guys, PAs are gone, okay? For good, forever. Rubicon had a PA that failed. Hart had a PA that also failed. PAs are just not seen as stimulants for share price. And somebody one of these days has to do a PhD on what moves or does not move a stock price, and it will see that PAs do not move stock prices. Secondly, BNN, early spending, again, could go into mining assets for better result. Analysts do not base their decisions based on infomercials. You may put it out on BNN and think that you're going to get the dentist, but you don't want the dentist. You want the analyst who works for a pension fund or who works for a venture capital fund who knows where the stats are. Now, the next point is extremely important. A feasibility study, especially a 43-101 compliant one, is more effective. Why? Because for every penny saved, you will get a pound of benefit. All right, before talking to a VC, no ifs, no ands, or buts. Your PA goes into the garbage. It is too preliminary, and it's economic, and it's not financial, and there's no proven improbable, et cetera, et cetera, et cetera. And again, it's seen as a questionable soft cost inflator. Next slide, please. Thirdly, the mining company gets remote sensing and algorithms involved. And I've just reviewed 2 firms in this category, one with remote sensing and the other one with algorithms. Look, it's nice to go looking for new technology. Perfectly understood. But remote sensing, or AI, while promising, remains highly unproven. All right? Your project's already risky enough. It does not need more risk. Algorithms are proven, but require massive amounts of data for robustness. As algorithm design has proven, they're excellent for brownfield plays, but not as proven for greenfield junior plays where the data is weak. So again, projects have many unknowns and scarce resources. A pharma project does not need more risk. So again, keep your soft cost inflators down and you'll find more venture capital. Next slide, please. And now for the sexy copper, gold, silver molly play. Well, first and foremost, as Mark Twain once noted, a mine is a hole with a liar on top of it. And again, mining blew its credibility 10 years ago. So now people, when a mining company comes around, they're already subdued. Top of that, mining companies think that the 43-101 is the end. Unfortunately, the VCs see it as the start. Start on execution, least cost technologies, political cost, CESG, and supply chain issues. Additionally, your inferred resources need a better map. My God, 43-101s that I've read who literally forget about the inferred are shooting themselves in the foot. Why? Longevity, strategic future value into scarcity is now huge. And I put huge in capital letters. Why is it huge? Because once the mine is built, once it's up and running, once the permits are in hand, and you can find additional resources, the AISC drops like a rock, and the investor knows that they are in increased scarcity. Again, the problem is with the current net present value mentality as opposed to the future strategic value mentality. Also, you've got to remember that investors are armed with historical and current databases. So your 43-101 has to show comparable industry figures for all costs and contingencies. And I'll only give you an example, I just read a feasibility study which had a 15% contingency allowance for the project. Well, the industry in that country right now is running at 43% cost overruns. On top of that, if you talk to EDC in Ottawa, they'll tell you that in their broad experience, mostly LDCs, it's 90%. And in fact, Quebrada Blanca 2 in Chile right now, in the hands of Teck and Sumitomo, is currently running at 60. So you can wax eloquent about your 15% contingencies all you want, but when the industry basically suggests that it's going to be 3, 4, or even 5 times or 6 times higher, sorry, but the venture capitals, they simply pass. Why? Because they've got opportunity costs in other industries. Again, 40 years ago, there was no FAAMA-five. There was no Microsoft, there was no Meta, there was no Apple, there was no Amazon, and there was no Alphabet. Okay, now its role has been reversed. These are there, they're massive, they're eternal, they seem to be very well funded, they're paying dividends, and the venture capital is not going to be convinced mightily if it doesn't see some basics answered. Next slide, please. So here's a summary, and there will be changes. One, the market's moving to Asia, and Canada will have to as well. Canada, look, Canada once upon a time was blessed by God, Allah, and whoever else is up there. Canada had Europe to the east, Japan to the west, and the United States to the immediate south. It was surrounded by the G7, which had the majority of the world's GDP. Now the majority of the GDP is moving to Asia, or has moved to Asia, and it will be the dominant market. And LNG is a good indicator. I did the first 3 LNG deals in this world, in Algeria and in Qatar. Everyone was looking at Europe. Everyone thought that Europe was going to be the market. Wrong. In LNG, 75% of the market is in Asia. And surprise, surprise, 5% of the supply is in Asia. The other interesting thing about the market is that EVs will reduce and boost the need for many metals. Oh boy, this one's going to be interesting because right now there is not enough lithium or copper or cobalt on this earth to satisfy the existing EV needs. The industry itself is going to change. Costs must be fully and brutally reassessed. Consolidation will continue, favoring low and lower AIC suppliers. Innovation will continue with existing mining assets for higher yields, lower cutoff grades, and larger TSFs, of course, on merged assets. And, just a point on the lower cutoff grades. It's great to move your cutoff grade from 0.3 to 0.1 and tell the world about it. But the automatic question is, do you have a permit to triple the size of your TSF? Which has stopped two mining companies cold. Now, in the capital markets, dividends are here to stay. They're after tax and they're eternal. Growth capital is gone due to no more mines. The FAAMA-five are here and growing, and there were none there 40 years ago. But some venture capital firms will look, due to scarcity and need to reduce risk, because of LOM. LOM is the curse of the industry, okay? At the end of the day, there's only so much in that mine, and usually the deeper you go into a mine and the higher your costs go. So therefore, the mining company has got to pay more attention to the VC market practices, because if the VCs come, others will come as well. It's got to focus on soft cost reduction relative to the hardcore asset risk. And when I think I've mentioned soft costs about 5 or 6 times in the course of the presentation. Much too fat on the front end, and you just scare away the investor from the get-go. So you've got to forego a lot of traditional habits. I know this was the way things were done in the past, but in this going into the future, stick to the proven on the hard costs and the known on the hard costs. And finally, map your inferred resources for future strategic value, because the industry now has life of mine sickness. Ladies and gentlemen, that's pretty well it. Next slide, please. Yes, I speak 3 languages and I can receive questions in all 3, but I'm still addicted to espressos because I was born in Italy, unfortunately. So with this in mind, I'd like to turn it back to Terence, who may have accumulated a question or 2.
Thanks, Mauro. Yeah, I had an espresso before the meeting, so I feel good. A double espresso, as a matter of fact.
Good. Good for you. We'll make an Italian out of you yet.
All right. Send me the machine. Mauro, there's enough of a pool of capital for risk sector investments and participation. Obviously, we have technology sector come in the last few years. Like in the markets we had about 15, 20 years ago, mining and oil and gas represented approximately 30 to 40% of the index value, okay? Now we're down to, I think mining is about less than 8% or 5%, somewhere around there, depending on how you calculate it. In the meantime, technology went from 5% to 25, 30%.
Exactly.
So in fact, now technology, we've seen quite a decline in the valuations as well, but they value it based on the basis of how much they're spending to membership subscriptions they have, maybe 2 years or whatever, then to revenue base, and now there are like no measures left. In the mining, we used to do the same thing. In the mining, we used to have on the measure of the growth projects, as well as how much land do they have and where they were and all these things. So you look at this risk capital issue, which is limited value in terms of and pool itself in the marketplace. But for mining to attract it, we're also becoming very geographically sequestered in certain countries because of the policy issues in many countries.
Yes.
Wouldn't that be better, in fact, for the Canadian mining industry, which represents over 2,000 junior mining companies, to have this issue of we give you a risk, we're going to reward the risk that you're taking, but we're going to focus in certain countries. And do you think there will be actually a better statement to do at this time?
Look, let me back off a couple of seconds to address your question. The world right now is in a state of change. Okay, and I'll give you 3 or 4 examples. When the Ford Model A came out, did cars look like Ford Model A 10 years later? No. When the DC-3 came out, did all planes look like DC-3s 10 years later? Absolutely not. When the first computer came out, did all computers look like that in 10 years later? Not. Cellular telephone, same thing. So EVs and all technology, as the raw materials needs will change and the raw material supply will change, are also going to change. I don't think any EVs will look like Teslas in 10 years from now. And the capital market also knows this. That's why it's very, very risk averse right now. So as the economy slows down and these changes, these appetites are changing as the economy slows, you're going to see fluctuations in valuations that have never been seen before. It's a very long-winded answer to your question, but I don't think Canada should do anything relative to the mining sector. I think the mining companies have to now learn to adapt or die to whatever the market will require.
Okay. Carlos, can you help me with the questions here? I don't see some of them. Yeah.
Okay. So let me just read the first question. Are there any of the major mine commodities, excluding gold or silver, that you would expect to see a 10% or greater decline in demand volume over the next 15 years? And
yes.
Yeah.
Nickel, I would expect to see a decline in zinc. I would expect to see a decline in lead. I would expect to see a decline in coal. I would expect to see a decline in basic metals, other than copper and nickel and cobalt, of course.
Okay. Next question. What do you mean by algorithm analysis?
Algorithm, simple. I'll give you an example that you can follow up on. Whittle algorithms has been very successful. He's now 82 years old. I think he's still active, but he's been very successful with brownfield mining companies, basically extending mining companies based on algorithms because of the data availability involved in them. And just Google Whittle algorithms, and you'll have a better view as to what an algorithm can and cannot do.
Okay. Next question is, I see this presentation is being recorded. Will it be available at a later date? The answer is yes. Okay. Just as after the Q&A, I'm going to show you exactly where you not only can you find not only will you be able to find this video, but you'll be able to access past presentations and the videos associated with presentations. So I would say in about 10 minutes, I'll show you that exactly. Next question. Bear with me for a second. Yeah, may we get the slides after the Zoom meetings?
Of course.
Okay, so what I'll do is, besides posting the video within a week's time, okay, we will also post the deck of slides, so you'll have access to both. But like I said, in about 10 minutes or so, I will show exactly where you can find it on our CIM MES website. Next question is, in your business model, there is no room for exploration discovery because VC will not fund that end of the supply chain. How can the majority of the mining sector survive without the junior sector if the producers carry out so little greenfields work?
Yes, VCs will finance it, but not if they see excesses in soft cost deployment. This has been the message I've tried to deliver again and again and again in the course of this presentation. It's the soft cost deployment that scares away the VCs, and it scares them away from the hard cost deployment.
Okay. Next question is, can you elaborate on why life of mine is such a curse? Not all deposits, especially underground, can have a long life mine lives, 10 plus years.
Simple. The venture capital firm, one side sees a Microsoft with endless potential, or it sees a Twitter with endless potential, or it sees, an ongoing entity as an endless potential. And on the other side, it looks at a mining company that has one certainty associated with it, life of mine. And therefore, given the certainty of life of mine, that's already a risk. The venture capital firm wants to be absolutely sure that it reduces the other risks appropriately so that it can invest in the mine. But if you basically increase the level of risk by increasing soft cost deployment, obviously the venture capital firm is not going to be interested.
Okay, thanks, Mauro. Next question is, it says, since I was a banker, we have maintained a database on the key reasons why mining projects fail. Years ago, it was technical issues like grade and resource quantity. However, now the key reasons are social and community risks. What is your view on this?
I couldn't agree with you more. Look, 100 years ago, we were 1 billion people on the face of this earth. We're now 8 billion people, and no one's making any more land. So the probability of you being increasingly in somebody else's backyard are increasingly evident to anybody who understands Math 101. These issues are only going to be there and increasingly there. And as politicians react to voters, the mining company is going to find itself with an issue or two or three if it tries to short circuit this possibility. However, for the junior, I would strongly recommend that they not get involved in ESG issues. Why? The major, which will ultimately be buying out or bidding for that asset, will all clearly have strategies of its own, and it would appreciate a clean canvas rather than a canvas that's already got some hastily done or poorly done design on it. So again, for the junior, they should just stay away from the ESG issues, because the majors, be it a BHP, be it a Vale, be it a Goldcorp, or pardon me, be it a Newmont or a Barrick, are going to have some very proficient people that can run with that as needed by the end of the day. But yes, I was a banker. I too kept tab on what made and did not make projects. And in the ESG category, actually, we had two subsets as to where the issues were initiated by the mining company or where they were initiated by the host government. And up until a short while ago, the majority was the mining company fuck-ups rather than the host country fuck-ups. So again, leave it in the hands of the majors, and also the majors still have to learn a thing or two about managing the ESG risk.
Okay, and I got a good question actually before we go on with the questions. Okay, if you were to offer advice to a junior mining company trying to raise funds, right? And they talk about, well, how do I compete with entities like Amazon, right? When it comes to raising capital, what's the top 5 things that they should consider?
Hard costs, hard costs, hard costs, and hard costs. No, guys, I can't emphasize this enough. A, the venture capital firms have their databases. B, they want to see good hard numbers. They don't want to see soft cost deployment. The more numbers you throw at them, the better, especially on the inferred resources, which gives them strategic future value. They've just, if they come up with that song and they go to New York, they will find money. But if you want to be in a cushy downtown office, if we want to hire all your old buddies, or you wanted a two-tier ownership structure, or you want to hire unproven systems such as AI or algorithms, you are not going to find that money.
Okay, so the next question is, money goes to where there is some political and indigenous stability. Your thoughts?
Once again, please.
Money goes to where there is some political and indigenous stability. Your thoughts?
Absolutely. Look, the current CEO of Barrick made his fortune in Africa. Why? He discovered long ago that when you hire locals, you achieve several objectives. One, you, of course, hire locals who are not expats. Two, you hire usually the best that are to be found in the country, especially if you throw in a clinic and an elementary school on the side. Three, you hire stability because expats move to wherever else they're going to be paying, whereas the local tends to stay. And last, but most importantly, you hire political stability. Why? The locals will tell you overnight if the local governor no longer gets along with the national president, whereas the expat will not have a clue. So basically, you got to make friends with the indigenous people. The indigenous people are your stable, highly technically qualified, and politically connected local cost components. And again, this consolidation will continue, and it's going to continue favoring low-cost suppliers. So you want to hire as many indigenous people as possible.
Okay, so next question. Since the world is becoming environmentally friendly and VC do not like unproven technology, how do you think this will affect the future of mining?
Wow. One more time, please.
Okay, since the world is becoming environmentally friendly and VC do not like unproven technology, how do you think that this will affect the future of mining?
It's going to have to adapt. It's just a question of adaptation. People, time and time again, people are approaching me for my advice on how to avoid a problem. And I keep on telling them, embrace the problem, adapt with it. If the problem demands X, you must adapt to X. And same situation in answer to your question. There are changes out there, yes. So adapt to them.
Okay. Next question. Does your argument mean that a project has less value in a one project startup than in a conglomerate?
Yes.
Okay. Okay, next question. Technologies that replace things like cyanide. Okay, I'm not sure where this is. Oh, this is going back to the question about with regards to environmental friendly and VC and unproven technologies that replace things like cyanide, etc. So, but you did answer the question. So, okay, let's move on to the next one. Majors are not as dependent on VCs. So what is preventing the majors from focusing on strategic value instead of NPV in developing new projects?
That's why they're merging. They don't know right now. So it's better to buy out your neighbor than to wait for and to pray for additional life of mine because of your neighbor's reserves or resources than to sit around and do nothing.
Okay. Last but not least, the question is with respect to the majors, can you comment on the current rate of share buybacks versus paying excess cash as dividends?
Oh, that's, first and foremost, my own personal preferences, and I'll give this out free of charge. I do not like share buybacks. You've got a share, you've made money from it. Buying back a share just to prop up its price means absolutely nothing. Why? Because the increased price is meaningless. After the share buyback occurs, about usually a week or two later, the price is back to its old doldrums. Why? Because all of a sudden there are fewer resources in the company. The market realizes that and simply says, okay, now that there are fewer resources in the company, there's a lower value in the share price.
Okay, we're gonna give the opportunity for one last question, and then what I'm gonna do afterwards is I'm gonna show you exactly where you'll be able to find this video in about a week's time, and also the slides. So one last question before we stop with the questions. Actually, Terry, you might have a question.
Yeah, if there are none, I just want to ask you the question, Mauro, about the contingency numbers on the capital costs.
Yeah.
In the last 40 years or so, we had low inflation, for instance, and 15-20% didn't match the expectations. Almost all the projects have been about budget. Granted,
Yeah.
there were some scope changes. There are some scope changes, some of them. But the future, we have inflationary pressures, and plus the fact that our costs, general other costs have gone up, operating costs, which means we have bigger scale projects ahead. And a percentage of 15-20% on a $5 billion project is different than on a $2 billion project. So what would be the number as a contingency they should be using in the future for the market to accept it's reasonable?
Simple, watch. The company can continue to use 15%, but in a little column beside the 15%, there should be another column basically showing national or regional or international averages in that contingency column. And then the investor can basically sit down and simply say, hey, you see 15%, the market is 43%, just to use an example from my PowerPoint slide. Why do you only see 15%? In that case, the company can have a very good answer or not have a very good answer. And once again, the reality of that answer is what will dictate the investor's requirement. Because if the entity says 15% versus 43, and there's humongous potential in inferred or in future strategic value, the investor can simply say, great, I can live with that risk, because even at 43%, this project is going to be extremely well situated in 5 or 10 years. But it's just the practice in the past, or even in very recent, and I just don't want to mention names, but I pointed this out to the mining company, and they just looked at me and simply said, well, we're going to get 15%. And I just basically said to them, well, you're not going to find many investors. You've got to come up with a story that's better than, this is simply what you believe in. But again, it's just a question of clarity in that feasibility study of just you can put down whatever percentage you want, but in the column next to it, just simply put down what the national or regional or historical averages have been for a typical mine of that project or that location, just so that the investor can see what the differences were, and then they can just sit down and negotiate what the contingent funding vehicles might be, because, you know, if you think 15% and the average is 43, you better have a really good answer in terms of strategic equity or strategic debt or contingent equity or contingent debt or whatever the case may be. But right
Thanks for
now,
the,
there's just this, again, this unbelievable belief that, well, you know, 43.101 requires it, so we can put in whatever assumptions we want. And in the one case of the recent feasibility study, I actually asked the engineering firm who did the feasibility study, you know, what their thoughts on this were. And they basically said, well, this is what the client wants.
yeah, yeah. Well, there'll be some changes on the 43101s as we expect from the OSC in due course,
Well,
maybe a year from now.
the problem with 43101 is it's not being enforced. I mean, I've got a couple of examples where the QP is the CEO. You know, I
Okay.
mean, what's the use of having a QP, an NQP, if it ends up being the CEO?
So just coming back, maybe a final question. If there's nothing else, Carlos, on the roster. Are we foreseeing that in the near future, the way the need of capital is quite immense and a lot of companies around, and unfortunately, market not paying attention to them, do you see more mergers in the junior sector?
Oh, definitely, but not between mergers. Basically, they'll be picked off one by one in ascending AISC order.
Fair enough. Carlos, I have
Okay.
no other questions here.
I have
You pick
one-
up for the
yeah.
for the finale here. Yeah.
I've got one last question, just literally hot off the presses. What would you put the base for ex-US CAD for current projects as the rate is significantly higher and rising?
One more time, please.
So what would you put as, what would you put the base for ex-US and CAD for current projects as the rate is significantly higher and rising?
I'm afraid by CAD, you
I
mean?
think it's because I think what they're trying to refer to is, you know, with the rising U.S. and Canadian dollar, right? You know, how, you know, what would you put as the base currency instead?
Currency exchange, Canadian, US.
Yeah. Right. There. Sorry there. No, very simply, I would run a series of, I mean, you have to use the current rate, and then you just run sensitivities. You run a sensitivity of, let's say, -5 cents, and then +5 cents. But be very careful there, because you know, that may radically change the return of your project. You know, when you go through a 10-cent or 10% currency differential, sourcing capital expenditures may radically alter as well. So you have to go into, all of a sudden, supply chain issues, which themselves may bring a host of risks into the project.
Okay. One last thing, but it's not a question. Okay. Comment, and it says here, thanks, Mauro, for these insights. Very interesting discussion. So thank you for that part. Okay. So let me show you our website. Okay. So some of you may know our MES website. Some of you may not. If you go to CIMMES.org, this is where we reside on the internet. If you go under national right here on top, right, this is where you'll be able to access the videos, right? If you go here under highlights from past CIM events, right? It's situated here, and you will see shortly, right, this updated with Mauro's presentation, right? So as you can see, if you want to access previous presentations, you just have to go here and just scroll down, right? So most of them we have both the video and the slides, right? And so when you see Mauro's, when you're looking for Mauro's, it'll be the one on top here, just above June 29. And these are all for your leisure, so feel free to review them at your leisure and download the slides if you're interested, okay, where appropriate. what I suggest is also take a look at our website, because there's lots of interesting stuff on our website. So if you look here, we have an upcoming calendar, right, of upcoming events. So this will always be populated when we have something to advertise. If you're interested in information about CIMVAL, INVAL, just click here, right, and you'll get access to information with regards to CIMVAL or INVAL. Also, we have information about membership through CIM. We've got how to contact us, right, a little bit about our history and so forth. But one of the recommendations we make is this, right? If you're interested in getting involved with MES, regardless of where you are throughout Canada, please let us know. Right, we're always looking for good talent who is interested to spend, say, something like at least 10 hours a month, and we'll definitely have something for you to do and to keep you entertained. And by simply filling out this and informing us that you're interested in volunteering, and we'll get back to you very shortly with more details. So on that note, I'll let Terrence take over, and we'll take it from there.
Well, the only thing I will say is that it's been a fascinating presentation, Mauro. A lot of insights, a lot of perspectives, which is our title anyway. We just filled all the gaps in between. Thanks for answering all the questions. Look forward to seeing you very soon in some of the conventions, which will be more material than promotional, let's say. And thanks, Carlos, for helping out here. And thank you, CIM, for chairing this meeting, CIM and MES specifically. Thank you, and have a good evening, everybody.
Good evening.
Take care.